Valuation of debt and equity are complementary tasks that together determine a firm's total value. Both rely on projecting future cash flows and discounting them at appropriate required returns that reflect risk and priority of claims. Debt valuation. For fixed income instruments like bonds, the basic value is the present value of contractual cash flows, coupon payments, and principal, discounted at the market yield required for that instrument. Bond price equals S CFR T. 1 plus Y, T, where Y is the yield to maturity, YTM, for a bond price to match those cash flows. For publicly traded corporate debt, the appropriate discount rate is often the risk-free rate, plus a credit spread that reflects default risk, liquidity, and call-put features. For short-term or bank loans, valuation may use current market replacement pricing or expected future interest margin approaches. Key practical considerations for debt. YTM and current market yields reflect market-implied return for holders. Use the current yield curve for discounting non-parallel cash flows. Default risk. Model expected cash flows using probability of default and loss given default, recovery rate, or incorporate a credit spread that embodies those expectations. Embedded options. Callable, puttable, convertible debt. Change cash flow patterns. Value with option-adjusted valuation, or by decomposing into straight debt plus option value. For floating rate debt, value is less sensitive to rates but must account for credit spread and any floor cap features. Duration and convexity measure interest rate sensitivity and are useful for stress testing and hedging. Equity valuation. Equity represents the residual claim on firm cash flows after meeting debt and other obligations. Main approaches. Dividend discount model, DDM, value each SDT, 1 PSARE, plus terminal value, where DT are dividends and RE is the cost of equity. Gordon growth, constant growth terminal value equals DN+1, RE, G. Discounted cash flow, DCF. Two common variants are free cash flow to the firm, FCFF, discounted at WACC to get enterprise value, and free cash flow to equity, FCFE, discounted at the cost of equity to get equity value directly. FCFF approach. Enterprise value equals S FCF-T. 1 ACC T plus terminal value, equity value equals enterprise value, net debt plus minority interest preferred stock adjustments. Residual income model. Values. Equity by current book value plus the present value of future residual incomes. Earnings, re-ex book equity. Relative valuation. Use market multiples, PE, EV, EBITDA, PB, EV sales, from comparable companies and apply them to the target's metrics. Multiples are quick checks and market consensus anchors, but rely heavily on selecting true comps and adjusting for growth, margin, and capital structure differences. Cost of capital. Estimating discount rates is central. Cost of equity, commonly via CAPM, RE, URF, plus VUS, RUM, REF. Use an appropriate beta, levered, unlevered adjustments for capital structure, and market risk premium consistent with historical or implied estimates. Cost of debt equals risk-free rate plus credit spread. After-tax cost is 1 tax rate. X cost of debt for WACC. USC equals E plus D, X, RE plus D, E plus D, X, 1, tax rate, using market values for E and D. WACC is the appropriate discount rate for FCFF. FCFE should use RE terminal value and growth. Terminal value often dominates DCF results. Use an economically plausible perpetual growth rate, no higher than long-term GDP inflation expectations, for Gordon growth, or an exit multiple anchored in comparable transactions or trading multiples. Test results across a range of terminal growth rates and multiples, from enterprise to per share. After valuing enterprise value, subtract net debt, minority interest, and add non-operating assets, cash equivalents, investments, to derive equity value. Divide by diluted shares outstanding to get per share value. Account for options, warrants, convertibles, dilutive effect, or bifurcated valuation for convertible securities. Adjustments and complexities. Consider working capital cycles, cyclicality, non-operating assets, pension deficits, off-balance sheet liabilities, lease obligations, capitalize operating leases, contingent liabilities, and taxes in each period. For firms with negative or volatile free cash flow, relative valuation or excess return models may be more informative. For hybrids and convertibles, value debt and equity components separately. Convertible yields straight debt plus option on equity, or use option pricing models for the conversion feature. Practical workflow and robustness. Typical steps: forecast operating performance and cash flows, choose appropriate discount rates, calculate explicit period PVs and terminal value, reconcile to market transaction comps, adjust for non-operating items and net debt, derive per-share metrics, and run sensitivity and scenario analyses. Document key assumptions, growth, margins, capex, working capital, discount rates, and stress tests to show drivers of value. In summary, debt valuation focuses on contractual cash flows and credit risk. Equity valuation focuses on residual cash flows and growth prospects. Consistent assumptions about the business, capital structure, risk premia, and terminal conditions are crucial. Use multiple methods and sensitivity analysis to triangulate a reasonable valuation range.